Hello, and welcome to the California Center for Employee Ownership. This is the first of our brief podcasts on items of interest to our members. Hopefully, you're here because you're interested in something about employee ownership, and we're here to help. For today, we're talking about the most maybe serious business issue to face this country in many, many years, if not decades, and that's the concept of business succession. And as the number of businesses in our country are changing hands as the baby boomers, if you will, begin to retire. So we're going to start talking about it today, and I think it's important for us to begin by focusing on the role that various forms of business play in our economic structure. To begin with, we tend to focus most of our attention on public companies, but in reality, the public companies, in terms of our productive capability, provide a relatively small percentage of the total. As you can see from this sort of approximate pie chart, the public companies are, a relatively small percentage. The private, as we call closely held companies, constitute a much larger percentage of the total productive capability in our country. And we have those divided up into two pretty important subsets. One is the private companies that are relatively new and growing, and then the second is the private companies that are at a stage where they're looking for transition of ownership and they're looking for liquidity for the current owners. And as you can see from our pie chart, that's actually a majority of the companies in our country. And then we have a small sliver of companies that are already employee-owned today. This is a really important understanding for us because you have to take into account that these companies, while they provide that large a percentage of the productive capability of our country as a whole, are each of them individually fragile. Each one of them is individually a part of it. So we've created some really serious overriding business succession issues in the last few years. First of all, as I said, public markets are a relatively small percentage of the total productive capability in the country, in the world for that matter. The vast majority of wealth in this country is not in a liquid form. It's in the form of capital assets, of stock in companies. And these illiquid assets are really hard to value, and they're harder for the owners to access. And then we start to the kind of nightmare scenario, which is within the next 10 years, a very large percentage of that total productive corporate wealth in the U.S. will have to change hands as the people born shortly after the Second World War begin to retire. And it's really important for us to get a good handle on how that's going to play out. And of course, it starts from the issues of the people that own those businesses. People will have family concerns for both their spouses and their own retirement and how they're going to get on, their children and leaving an estate. But also these are mostly entrepreneurial people who have a real interest in business continuation and how their employees survive through the change in their business. They also are very concerned about tax and finance, about, we may have never had a more tax-averse generation than the one we have now. And then we also find that these business owners very frequently have pretty intense personal commitments to philanthropic intent. So they support lots of charities and other things. As they approach the end of their business life cycle and they start looking at what they want, they have a series of expectations for the most part, and we run into them all the time. There is a minimum acceptable price. There is a time horizon. They're sometimes in a hurry, sometimes have a leisurely period over which to try to do it. They are definitely interested in there being a continuity of the business for the management group and the employees and vendors. As business owners, they may stay involved in a business even after they've transitioned it through board seats or other things like that, or they may be carrying paper or, having personally financed a sale. They also are very specific about what's the form of an acceptable buyer. They're almost always in these entrepreneurial owners' eyes, circumstances that limit the audience that they would have. And then there's many other related outcomes, all the things that are attached to what these folks add to their wealth and how they create wealth in communities and so on. So we have to ask ourselves, well, what's going to happen to all those businesses? I mean, it's a very large slice of the pie, and where's it going to go? Some of it, of course, may be handed down to future generations. We are, though, experiencing a phenomenon in which most of the business owners will have educated their children beyond their businesses, and so finding heirs who are interested in taking over, especially manufacturing and other kinds of businesses, are slim. Some companies may be large enough to just make public offerings and find their way out of ownership that way. There may be some that are attractive for synergistic buyers, companies that are looking to expand by acquisition, and some may be attractive to the financial buyer community, the M&A community. But the truth is that a vast majority of those companies are smaller companies that are more locally operated, that are not of interest in any of those. And so if you don't have generations to hand down to, many of those companies will wind up simply being liquidated. And that, honestly, as we'll see, is the worst possible outcome. We're here to propose, the California Center for Employee Ownership is here to propose that a better alternative for a lot of those companies will be to partner with their employees, basically, and find a way to sell the company for its full fair market value using an ESOP, ESOP. Now, you may wonder what an ESOP is. Well, it's an employee stock ownership plan. It's a defined contribution retirement plan. You may in your company already have a 401k or a profit sharing plan where contributions are made. They're deductible to the company. They're not taxable to employees until employees later draw them out. With an ESOP, though, we have two specific characteristics that differ from all the other types of retirement plans. The first is that an ESOP is required to invest primarily in stock of its own company. So whereas every other sort of retirement plan is forbidden from investing too heavily in its own company stock, ESOPs are required to invest up to 100% of their assets in company stock. Second, the ESOP, unlike any other retirement plan, is authorized by federal law to borrow money backed by the credit worthiness of the company in order to acquire shares. So the ESOP becomes a very useful tool for stock transfers from existing shareholders or as a capital raising vehicle for the company or for other things, in that the ESOP is available to purchase stock, can use borrowed funds to do that. Whatever is purchased by the ESOP becomes an asset of this trust, and it's held in a security for the employees who participate. As that plays out, ESOPs then become a really versatile tool that can address a wide range of financial and employee relation objectives, but for our purpose here becomes maybe the ideal tool to begin trying to do a business succession strategy for a current owner. And so when you do approach business succession this way, rather than facing the potentials of liquidation and all the other things, all of the stakeholders in your company through an ESOP process can be put in a position to take this equity into the next generation of private ownership. ESOPs can be a controlled, friendly buyer. By law, they must not pay more than fair market value, but they're allowed to pay fair market value. The tax laws provide really amazing incentives for sales to employees, deductibility of all the contributions, deferral of tax, even deferral of tax on the sale by the original sellers. In short, the ESOP is the most tax cost-effective way to finance a purchase of company stock that's anywhere. And they can create liquidity in an illiquid estate so that it can be better coordinated for charitable purposes or otherwise. Ultimately, the ESOP is an ideal outcome for preserving a legacy, getting liquidity out of the entrepreneur's equity, and to be the most appropriate partner in sustaining the business into the next generation. We have some highlights. The ESOP companies that are already there and reporting show performance that is 8 to 10% more productive after they become employee-owned than it was before. ESOP company retirees can be expected to retire with 2.5 to 4 times the retirement income they'd expect otherwise. ESOP companies are much less likely to lay people off in downturns. If you look back at the recent history of downturns in the economy, ESOP companies were only 1/5 as likely to go out of business during those kinds of disasters. So we're seeing then not only connections within the company, value being built up for employees and owners, and as we've discussed it, but also in the communities at large. There's constant research going on in this subject especially, but we have initially some really strong suggestions that employee ownership is going to be linked to healthier county and community economies in terms of economic stability, income stability, lines of employment, tax base, all kinds of other things. Increased employment goes along with ESOPs where they're able to study it. We're really intrigued by this initial research, and it's continuing. But the trend is pretty straightforward, and it conforms with some things that we've found in the past. Historical general social surveys, which survey all of the businesses in the United States, showed that in the last downturn, 12.1% of the total respondents had lost jobs. But if you looked at employee-owned companies, the percentage was only 2.6%. If you translate that into community impact, without employee ownership, we would have lost 1.8 million more jobs than in employee-owned companies. Benefit to the federal tax revenues that come out of that when people kind of wonder where is the value to the government of giving us all these advantages. We would have $14 to $23 billion more in tax revenues per year. So it's a really compelling picture. It is one of the few, honestly, win-win-win-win situations. The business owners have a market. The employees have a future. The communities have more stability in terms of all of the things that are important to communities. And moreover, we wind up with some really extraordinary companies where the employees think and act like owners, take responsibility for the companies that they work in, and are kind of communally building wealth for themselves. So if any of that seems interesting to you, or if you think you might like to pursue it, it's the goal of the California Center for Employee Ownership, in coordination with regional and state centers all over the country, to be a resource for information and for initial assistance. If you have any interest in pursuing any of this, my email address and phone number are all there. You can go to our website, which is www.ownershipcalifornia.org, and a lot more details will be on there about our board and things that we do. But we're happy to hear from you and happy to help guide you through the initial phases of it. So thanks for giving me about 15 minutes of your time, and I hope you found it useful, and we'll look forward to hearing from you. Thanks.